This is what it looks like from 10,000 feet. The checklist we need to have in order to confidently enter a trade in the market. A liquidity sweep that happens inside of OTE, delivering from a higher time frame fair value gap, put it in SMT, get an internal liquidity sweep, inverse a fair value gap, see a change in the state of delivery with a clear draw targeting opposing liquidity. We enter the trade, we set our stop loss, and we let the trade play out. Here's what that looks like as a bearish example. We've come back up into the OTE range where we've then swept liquidity. We've put in an SMT at these highs, tapped into a higher time frame fair value gap, had an internal sweep of liquidity. We then get a fair value gap that is inversed, a change in the state of delivery, and we enter our trade either here or at the pullback of the change in the state, targeting opposing liquidity. Here's a fair value gap that we can see on the 1 hour time frame. Let's mark that. And then let's plot our OTE. So as you can see, we have put in a fair value gap in this OTE range here. Now I'm going to zoom in to the 5-minute time frame. Here's our 1 hour fair value gap, and here is the range that we plotted. So let's look at our checklist. Liquidity sweep. Well, we've had, we're going to jump down to the 1 minute now. We're going to move this over here just so it's not in the way. We've had a liquidity sweep. Let's mark that as buy-side liquidity. What's next? OTE. We are in, as we discussed, OTE, this range right here of the previous dealing range. Delivering from a higher time frame. As we noted, we are delivering from a 1 hour time frame. That just means that there's a higher time frame fair value gap that we have tapped into. In this case, we've tapped into it in this whole area, and it seems to be holding. We have not inverted it. It is being respected. SMT. So here's our liquidity on NQ. And at that same time on ES, we also swept liquidity. So no SMT there. And if we're to look here, we'll see that we have swept liquidity on NQ, but we have not swept liquidity on ES. So this is our SMT. Internal liquidity sweep. So in this case, we have, in fact, had an internal liquidity sweep. Simply means that after we swept the buy-side liquidity here, we created new liquidity and quickly came up and took that. So we've had liquidity sweep, tapped into a higher time frame fair value gap, put in an SMT, had an internal liquidity sweep, created a fair value gap that we have now inversed, and then get a change in the state of delivery. We can enter our trade here, set your stop loss to this high here with your take profit down here for a nice 4.43 risk to reward trade. And let's see if we were to enter there, right, with pull back to the change of the state. And you would hit your first take profit there. You could take all your profit off here, leave a runner, meaning, let's say we had 4 contracts. We can sell 3 of them here, move our stop to break even, or even a little bit into profit, and then let 1 contract run down to the bottom. That way you capture the whole move without having to risk everything. If it even comes down to there. It looks like we're going to get it. Yep, boom. And that would have been your full take profit. Let's look at a bullish example. We have put in a high, a low, a higher high, and we are coming back down into our OTE range. We've tapped into a higher time frame fair value gap. We've put in an SMT, so that means here on ES, we've swept this liquidity. We've swept internal liquidity. We've inverted a fair value gap. We've had a change in the state of delivery, and we have clear opposing liquidity on the opposite side. Here we are on the 1 hour time frame. We're going to mark this range here. As you can see, we've come back down into OTE. No, we have a little fair value gap there. Let's see if there's something better on the 15. Yes, look at this. Okay, so we have a nice 15-minute fair value gap here that we are delivering out of. We have, I'm going to delete this for now. We have swept liquidity here. And we have then had an internal sweep of liquidity here. Let's see, on ES, we have swept this low here. And on NQ, on ES we've swept this low here, and on NQ we have not swept this low here, which means we have an SMT on the higher time frame. That's fantastic. So SMT in the higher time frame, you've got your sell side liquidity that was taken here. You've had your internal liquidity that was taken here. You're delivering out of this 15-minute higher time frame fair value gap. So let's zoom in even further to the 1 minute and see if we have an entry. All right, we're a little late on this one. This is our internal liquidity sweep, the bigger picture time frame. So this is a good example of what happens when you have stacked fair value gaps like this in our entry criteria area. So you have a fair value gap here, you have a fair value gap here. So what you will do is connect all of the fair value gaps and make it one big fair value gap, because you're going to need to inverse all of them. So this would be our fair value gap. Our change in the state of delivery would be up here. I mean, look at this. It just bounced off that perfectly. Let's just do this. So we come down. All right, we enter here. And we would be targeting this high here, going long. So that's our entry. This is pretty decent risk. You can, if you wanted to, yeah, it's pretty good risk reward. You could also put it below, just right below the fair value gap, because this is still a pretty big drop here. It's another 28 points. And just make sure you have a tighter risk. And let's see what happens. Okay, I'd probably be break even at this point. So we'd move our break even to right here. Profits up here. Oh, wow. Boom. All right. And that hit our take profit for a nice $1,300 run. That's it, guys. This is your model.